This week, we're talking about the export market and then diving in a little bit into the U.S. energy market. Hello and welcome. My name is Will Robinson with Brownfield Ag News, joined as always by the University of Missouri's Ben Brown on the weekly commodity market update. Ben, how's it going?
I'm doing well. How are you this morning, Will?
Pretty well. This time of year, it's heavy baseball time. The Cardinals just took a series from the Braves, but then lost a game to the Pirates. But you have a little bit of better news as our set-in Royals fan over here.
Yeah, the Royals are hot. They're doing great, coming out of the All-Star break firing. So we'll see. We'll see if they can keep this up.
We need to, Ben, you're really excellent at breaking down reports and setting up numbers in a very digestible way. We need to do some sort of correspondence on overall ag production of general states and then the correlation to how good their baseball teams are to see who's really fueled by their state's agriculture. We got to see that.
Yeah, that might be true for Missouri this year. I hadn't thought about that, but yeah.
There you go. But no, Ben, we have a pretty large scope on a couple of topics we're tackling today, but I want to give a quick rundown on the prices that we've seen on the week. A lot of slight upward movement, pretty moderate overall week over week. So first looking at that September corn contract, up 10 cents at $4. December 24 corn up 11 cents at 4.15. September soybeans up 31 cents at 10.64. November soybeans up 28 cents at 10.68. Soybean oil on a cents per pound basis for September was just about flat at 46.22. Soybean meal on a short ton basis for September up $11.70 at 325.80. That September wheat crop for this year up 16 cents at 548. The July wheat crop for next year up 10 cents at 608. October cotton contracts down 0.82 cents at 70.04. December cotton down 1.77 cents at 70.67. And then that West Texas Intermediate crude oil contract down $2.53 a barrel at 78.41. So Ben, a lot of benefits coming to most producers, and then maybe some input costs sliding down just slightly as well. So what does this tell you on the week? What was your outlook?
Yeah, well, so the kind of the big number there is the soybean market right in the middle. Most of that rally came on Monday. As our viewers know, that we record this on Tuesday, and the soybean market's up again, another 7 to 8 cents again this morning. And so, we've seen a nice little rally here in the soybean market. Most people believe that that's a combination of warmer conditions expected over most of the Corn Belt here in the near term. And then there was also, a surprising interest rate cut within the Chinese market yesterday that a lot of people also believe helped fuel, a little bit of that soybean rally. So I think it's a combination of the two, but it's certainly the forecast is still suggesting, growing conditions that, support good production, but it has turned drier and hotter. And as we know, August is a key month for soybean production.
Well, and a lot of parts of the Midwest, it's really been kind of a split picture, I guess, in the Midwest. A lot of different things going on, where you're sitting there in mid-Missouri, a lot of rainfall. We've got recent, derecho events looking over toward Iowa and Illinois. And then it's a whole other picture, too, in the Eastern Corn Belt. But overall, this crop looks like, it's been progressing pretty well. The crop conditions overall have been of good quality. But Ben, talking about that Chinese market, we are seeing a little bit of more interest maybe in some export sales there. June was up over last month, and then again, June of this year was up over last year's June, at least on the soybean side. So whenever you're looking at the Chinese market in particular, talking about maybe that interest rate shift there, what's your expectation for China moving forward? They're always a major factor within the export discussion, but that trade this year has been a little bit iffy, but maybe some positives are moving forward.
Yeah, so you are right. We have seen increased imports of soybeans into the Chinese market here this month compared to last year, and really we've seen this building here over the last couple of months, and so it is, I guess, positive to see China buying soybeans. It's probably a little bit of a discouragement to see that they continue to buy large percentages of their soybeans from South America. Brazilian harvest has been completed for that first crop soybeans now for a little while, and so this is still their prime export season out of South America into Southeast Asia. But normally it's about right now that we start seeing increased shipments of U.S. soybeans into that market as we're kind of getting closer and closer to harvest. To do so, we would have to see sales on the books, and we haven't seen a whole lot of sales to date. Our new crop book of sales remains incredibly weak for the new marketing year, 2024, 2025. And so that is a concern. If I just take what China has imported so far this calendar year, so January to June, that's the latest month we have complete data for, we're sitting here looking at almost 70% of Brazilian imports, soybean imports, 70% of Chinese soybean imports have come from Brazil, a little over 25% from the United States. So 70 to 20% January through June. That's up from a 55 to 40% split last year.
Yeah. Well, Ben, in some of your recent discussions that you've written up, you talk about maybe the potential for some more export demand in the next 3 to 6 months coming out of some production issues overseas. Do you think that that's going to help make up any of that gap? I know that might not change the balance between Brazil and the U.S. Or South America in general. That also opens up opportunity for South America as well. But how much of a benefit do you think that might provide to U.S. producers?
Well, so that's actually on the wheat side. I wrote that talking about global production of wheat. We have seen some challenges in the Black Sea region kind of materialize again. Their harvest is progressing. It's kind of been a little bit of an up and down movement. I think for wheat, estimates when they got in the field, the wheat was a lot better than what they thought. But as they've continuously moved a little bit further into the drier areas, the wheat production has really declined. And so now I think we're sitting here thinking, okay, we could see some further deterioration in the Black Sea region wheat. It's also turned really hot and dry in Eastern Europe and Western Asia. And that's going to have a big impact, not only on wheat production, but also corn production out of the European Union as well.
Well, and generally that it's an interesting thing. It seems to mostly be easiest to trade with your neighbors, just from a logistics standpoint. Last week, we talked about Mexico probably being the key asset for the U.S. in the near term when it comes to trade. But, outside of Mexico, how hard is it right now to try and target some of those other foreign markets across the Atlantic Ocean? Or I guess the other way, if you want to go across the Pacific.
Well, so you raise a good question. I think to some extent the U.S. has worked to help build some markets. We've recently seen some movement in Colombia, which is South America again, so kind of a little bit of a geographical, benefit to the United States. But as far as Southeast Asia, I continue to remind people just how big of a global consumer of grains and oilseeds the Chinese market is. Not only that, when we think about Japan, when we think about Korea, those are huge markets for U.S. commodities, and continuing to work to build market share there is beneficial because of just how big the pie is. Even a couple of percentage points of a market share increase amounts to millions of bushels of grains and oil seeds. And so, that is the reason we talk about it so much. And I think, our viewers and listeners know the importance, but it's always good to continue to remind people the importance of continuing to invest time and resources in building trade relationships there.
Well, looking into another sector of demand, we've seen a little bit of a shift on the fuel side, looking at ethanol production increasing pretty sharply up on the week. We're in the middle of the summer here, so a lot of cost analyses are being done too, just on the inputs of fuels as well. So, Ben, what's the picture moving forward when it comes to an energy standpoint as it relates to agriculture?
Yeah, so we continue to draw down these U.S. domestic crude oil stocks. This is kind of driven in multi-folds. One, we've seen high exports of oils from the United States, which we are the world's largest producer of oil, and yet we have traditionally not exported all that high percentage of our production, but we've seen increased exports of fuel oils, or let's just say there's global demand for the product. And so we continue to see domestic crude oil stocks fall. They were down 205 million gallons this week. That continues to keep that market rather tight. And as a result, crude oil has found kind of a comfortable spot right around $80 a barrel. We've been trading anywhere between $5 above and $5 below for a long time now. When we think about what this means for ethanol production, of course, ethanol is highly tied to the gasoline market. If we see increases in gasoline use, we do see strong ethanol demand. And that's what we've seen this year. Ethanol is a bright spot, I think, in our corn demand picture for 2023 and 2024, so our current marketing year. This past week, as you mentioned, we came also close to setting an all-time record weekly production volume for ethanol. Just one, well, they measure in 1,000 barrels per day, and I convert that to a million gallons measure, just because that's, I'm an American and we like to Americanize everything. Yeah, we like to Americanize everything. So, anyways, less than 1 million gallons, below our all-time record, and so very strong production. However, the expectation for ethanol production has been very lofty, and so I do have concerns that we might have to lower that ethanol production number for the old crop marketing year 23-24, just kind of where we're at. We're seeing near record production, but we got to have that pretty much all the way through the end of the marketing year to hit our current target.
So yeah, a lot to digest there on the fuel front, but really, Ben, it's been an interesting, period here with spurts of some trading news, but generally the markets have kind of stayed within a specific range here recently. Moving forward, what should farmers and ranchers really be paying attention to that could shift the markets report-wise, or just global events to pay attention to?
Well, it's pretty straightforward week for us, Will. Pretty much all of our standard reports. We do have some economic reports that come out at the end of the week, GDP estimates for the second quarter on Thursday, and then Friday, some personal consumption and expenditure data that's really kind of used as a inflation measure for the Federal Reserve. So this will be the last set of inflation data and economic data before the Fed meets next week for their July open market committee meeting. The expectation is no interest rate cuts here in July, but certainly I think they'll use this information to set up any type of cuts potentially in September.
All right. Well, thank you, Ben, and thank you for your knowledge and information for the program. Viewers and listeners, if you'd like to learn more about us and what we do, or our sister program, the Weekly Livestock Market Update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.